Well, hi there, everyone. Welcome to Chart This with Dave Keller. It's Wednesday, July 9th. Good to be here with you live, and welcome to the show. We're coming to you from a kind of nice, cool, and comfortable, slightly rainy, just how we like it, Redmond, Washington. We're all quite happy about this. Hot, sunny days the last couple days. Not a fan, at least the Keller family. We like the little chilly kind of rainy days, and here we are loving it. I hope you guys are all doing well, staying safe, and enjoying life wherever you're at. We're going to talk about the markets today. Big spike out of the open that was immediately sold off, but then the whole rest of the day, just kind of a nice, steady day of accumulation, enough to push the S&P 500 above 6260 going into the close, enough to drop the VIX back below 16, enough to make this look like a remarkably consistently strong bull market phase that just continues onward and ever upward, as we said many times in the year 2024. Feel myself bringing that moniker back. A lot of charts to review with you here today. We're streaming live on Facebook, LinkedIn, YouTube, and X, and I appreciate you so much tuning in live. Those of you that are doing so, please put questions on any of those platforms as we go. It'd be a pleasure to answer a question or two at the end of the live stream. Any of the questions we don't get, we'll put it in the mailbag and hopefully answer it on Friday's episode. By the way, just a couple hours ago, recorded a really fun podcast interview with the author of this book, The Missing Billionaires, A Guide to Better Financial Decisions, named Victor Haghani. Victor was one of the founding partners of Long-Term Capital Management. So that was a fun, rare opportunity to ask someone who had firsthand experience in the midst of that whole, major event in market history, just talking about the mindset going in, what he learned from it, how that shaped him into the investor he is today. But his book is all about risk management. It's all about bet sizing, some really good takeaways for individual investors. We'll look forward to sharing that with you soon. Hopefully tomorrow morning we'll have that out for you, and I'll let you know as soon as it's posted. But keep your eyes peeled. That was a fun one. All right, shall we get to the market recap? We'll talk looking at the S&P 500. You can see, yesterday, as we mentioned on the show, kind of a choppy, sloppy, sideways, nothing burger type of day. Today was the opposite. Today was a big move kind of day. Now, there was a huge spike out of the open, immediately sold off. It almost looked like we were going to give all of those gains back and more. But then from around 11:15 a.m. Eastern on, slow and steady incline, climbing up the mountain, and finishing near the highs of the day. That's enough to push the S&P up 0.6%, enough for the NASDAQ to be up almost 1%, and mid caps and small caps all in the green as well. By the way, in terms of random themes on the first page here, the small cap ETF starting to actually look less horrible and starting to look a little more encouraging. On a relative basis, in the month of July, small caps are actually outperforming large caps. Now, that is not a theme that has been very persistent. The opposite has been in the case for most of 2025. Large over small, really large over mid, mid over small. That's been the returns year to date in 2025. But keep an eye on small caps because the relative performance is starting to favor small caps here. I grabbed that chart to show you what I'm talking about a little bit later. Also keep an eye on the VIX. I mean, the volatility is so helpful, I have found, in this kind of environment, because the market is telling you that despite all of the macro stuff, right? Tariff tantrum, uncertainty in the Middle East, uncertainty with Russia and Ukraine, policy uncertainty with huge policy changes in the U.S. still seeming to come out, day in, day out. The market is in a low volatility bull market phase, right? The equity markets are telling you risk on, not a lot of risk out there. Spreads are narrow. Stocks and other risk assets are doing quite well. The vibe you get from analyzing the macro trends from a technical perspective versus the macroeconomic trends, I would argue, starkly different. The fact that the economic data we're seeing is not particularly great by far. And I had a good conversation with Callie Cox of Riddles Wealth Management about that particular issue a couple of weeks ago on the podcast. Still very much there. At the end of the day, right, what do you follow? Do you follow macroeconomic themes that seem discouraging or uncertain? or do you follow a market that continues to push higher? And I think you have to do that, right? As a trend follower, my goal is to follow the trends. The trends overall in equities still remain quite strong. Looking at interest rates coming down through the course of the day today as bonds rallied. So both stocks and bonds finished in the green today. The TLT was up about 1%. Rates generally trended downwards. You can see the 10-year yield finished today around 4.35. Long bond yield around 4.88%. 5-year point around 3.9%. And so rates, which had been kind of trending higher here recently, starting to rotate a little bit lower, something to keep an eye on. No real change in the dollar index, by the way. So continuing its general downtrend phase. Looking at the commodity space, kind of a split between gold up and silver down. One of the charts I grabbed for today is the opposite of that. It's showing how over the last 4 to 6 weeks, gold has been severely underperforming silver. While gold is starting to show some short-term signs of weakness, silver continues to remain quite strong. So between the two, silver over gold is now the play. Looking at the charts, I'll show you what I mean. Looking at the two price series and look at the relative strength of silver versus gold. Again, very much favoring silver here. Natural gas prices were down. Crude oil prices basically flat for the day. Big movements in the cryptocurrency market. You can see almost all 10 of the top coins tracked on the stock charts platform, all in the green. Bitcoin up about 2%. Ether prices up almost 5%. Bitcoin threatening new all-time highs. Bitcoin touched 112,000 earlier this afternoon. Currently trading just below that, around 111,000. I do still have positions in Bitcoin and Ethereum. My guest on the Market Misbehavior podcast tomorrow, Adrian Zdunchik, founder of the Burb Nest. He has built a pretty impressive community of crypto traders and does a lot of education and mentoring, and excited to get his take on the crypto environment as Bitcoin, attempting, so far failing to really follow through above previous all-time highs, but very, very close to doing so. Looking at the sector breadth, you can see 8 out of the 11 S&P sectors in the green today. Utilities up 0.9%. Industrials, number 2, up 0.7%. Tech, materials, consumer discretionary, all kind of tied for third, up 0.6%. Only 3 of the S&P sectors down. Consumer staples, which continues to underwhelm, down about 2/3%. Energy down about 0.5%. Real estate basically flat for the day. So an interesting one today. You have utilities popping higher. There's a utility name that was up big time, AES, on takeover announcement or speculation of a takeover. So it's up about 20%. That really helped to move the utility sector to the top of the list. That'll do it. But industrials and technology, number 2 and number 3. There are only 3 S&P sectors, as I shared with my Market Misbehavior Premium members in the monthly chart review earlier today. There are only 3 of the 11 S&P sectors where the relative performance has been strong enough to make my medium-term trend model bullish using the relative strength analysis. So basically, the only 3 sectors that are showing strong relative strength using my proprietary methodology: technology, which makes sense. Communication services, although it's very, very close to turning negative, and industrials were the third one. Those are the only 3. The others were all looking negative using my market trend model. All right, looking at advancers versus decliners, a little better breadth than we saw yesterday. You can see 61.8% of the New York Stock Exchange up, about 2/3 up, about 1/3 down, so about a 2-to-1 ratio there. On the S&P 500, almost the same, 60-40 between stocks up and stocks down. Small cap breadth, pretty powerful here. 2/3 of the small cap S&P 600 names positive, 31% negative. So the breadth encouraging. And again, I mean, the signs that I'm seeing, anything that I would say that's telling you the market's not going up, it's contrarian signals that just haven't really played out yet, right? It's extreme sentiment. It's big positioning numbers from the name exposure index, similar to previous market tops, but we haven't seen the distribution that would make me start to really get concerned. I promise I'll keep following those charts and keep you updated if I do see any shift. But for now, risk assets looking pretty decent here. Looking at the growth leadership names, what we call the Magnificent Seven and Friends. Broadcom up over 2%, NVIDIA up 1.8%. So 2 of the technology names really driving higher. Semiconductors, as we highlighted, I think on yesterday's episode or maybe on Monday, looking quite strong here. That's one of those bellwether groups, right? When I'm looking at the chart of the SMH, what I tend to find myself asking is, how bearish do I want to be when semiconductors look that good, right? When they keep making higher highs and higher lows. At some point, that chart's not going to look as good, and that's when I feel like you should have a healthy dose of skepticism about the sustainability of recent gains. For now, pretty good. We're going to talk about home builders as we get to the market carpet, because a number of them actually started to do pretty well here today. As a reminder, I do see some questions coming in on YouTube and some of the other platforms that we're streaming on. If you're tuning in live, just drop a comment as we go, or a question. When it comes to you at the end, I'll take a question or two. Any of the things we don't get to, we'll put in the mailbag. We already have some really cool questions to go through on Friday's episode. I'd love one or two more. So if there's a question that comes to mind, please share it with the class. All right, looking at the heat map here, what immediately struck me as I was looking at the heat map earlier this afternoon is how the biggest growth names are all pretty green here. And I think that's the story of what is driving this market higher off of the April lows. And certainly here on Wednesday, July 9th, we can see NVIDIA, Microsoft, Broadcom, of course, Amazon, Alphabet, Meta, all up over 1%, all in the green shades. And that's going to drive the benchmarks generally higher. So that's one sort of theme to continue to follow. Second thing that came to me as I was looking at this is just how green, average green color you see in the industrial sector. Industrials have ended up being one of the better sectors in 2025, but we're starting to see a reemergence in some of those charts, and some that I'm struck by are ones that have actually not looked particularly strong until the last couple weeks. Builders First Source, ticker BLDR, was up about 4.5% today. I did grab that chart to look at in the chart review portion of the show. Really rotating, I would argue, from a period of distribution to a period of accumulation, and changing from a pattern of lower lows to higher lows. And I think that inflection point that we're seeing is also reflected in like home builders, which are starting to break out to new 3-month highs and elsewhere. So these are areas of the equity market that have not been particularly strong so far in 2025, but in the last month, starting to really rotate to the upside. I'm also struck today by the underwhelming performance that you see in consumer staples. Now, some of these, like Philip Morris, so this is Altria, ticker MO, have been fairly strong charts, down about 3% today, MO. And this is coming off of a new all-time high just last month in June, but starting to rotate lower. Hershey's, which had just started to break to a new 3-month high yesterday, rotating back down about 5% today. So consumer staples continuing to underperform consumer discretionary, which basically suggests offense over defense is still the rule here, right? And until that ratio changes, we don't want to be too negative about risk assets. I'm also picking out here in the technology sector. I mean, it's not all great. And I will say the same sector that has like NVIDIA making new all-time highs this week, you also have an Adobe, which has been arguably a very underwhelming chart for the last 12 months. I mean, look at the little preview chart there of the last 12 months. I mean, take a step back from your monitor. I don't know about you, but that's a pretty consistent downtrend with some random counter trend upward moves during that period. But overall, this is a stock in a distribution phase. So technology is interesting. While some charts in technology look remarkably strong, many of the ones that we would talk about, it's not all they're not all the same, and there are some ones that have been struggling a bit. And I think those are the ones that concern me. Average chart. The good news is the average chart looks pretty good, and that's what's able to drive this sector forward. I think that's it for the heat map, to be honest with you. Kind of a mixed day, to be honest with you. I'm seeing plenty of neutral, amber-ish color, which on a day like today, the stocks that are up a bunch and the stocks that are down a bunch really kind of stand out. So again, things that impress me today, looking at the performance, are the big, Magnificent Seven names continue to be strong. The industrial sector, which as I'm going through the 11 S&P sectors, keep reminding myself that the industrial sector has generally been one of the top places to be. Underwhelming performance in some of the defensive sectors, particularly consumer staples. All right, let's look at some charts together, shall we? And then we'll take a couple questions. Ooh, I forgot to sort these. Hold on. We'll do this real quick. we'll put this, let's say here. This is something I usually do right before I start. I obviously did not. I was talking to my daughter before I started. And here we go. Not too hard to fix it. All right, we'll start with the daily chart of the S&P 500. This is a strong chart, right? My market trend model, which I review every morning, it's the first chart I look at every day, is a weekly chart of the S&P using a series of exponential moving averages, which I call my market trend model. It's just a reminder of the trends that are most important to me, and just reminding myself my main goal is to just assess the trends in the markets and identify what's working and identify what's not working. I would argue most investors don't need a crystal ball, right? They don't need to predict the future. That's not as important as you think it is. What is important is having good situational awareness, just being aware of what's happening. And I find a lot of times when investors get into trouble, it's not because they don't have the right predictive tools. It's just they don't have the right information in front of them, right? They're paying attention to the wrong things. And so for me, a disciplined and consistent process of reviewing the charts, reminding myself you ride what's working as long as possible. And when something starts not working, to get out of the way of that thing, that simple process of doing that consistently can create fantastic returns over longer periods of time. And so, with that in mind, the S&P is in an uptrend, right? We're above the 21-day EMA, which is above the 50-day EMA, SMA, which is above the 200-day moving average, and all of them are sloping upwards. That's a bullish configuration. So what would make this chart not bullish? And that's the question I would ask myself immediately after that initial assessment. If my look at this chart says this is a chart clearly in an uptrend, which it is, what would tell me that something is different? What would I need to see to say, okay, this is maybe no longer an uptrend and something I need to start to worry about? 21-day exponential moving average, often a really good starting point, right? If nothing else, be comfortable, be confident, as long as we remain above the 21-day EMA and we start breaking that tells you may want to start to revisit that bullish thesis. And again, might not be the end of the world, but it tells you something's different, right? Whatever primary uptrend you'd been observing is starting to change. That means the S&P above 6120, which is about 140 points below current levels, is still a pretty good chart. That's sort of your downside risk. And I think anything in this range is still a constructive chart. If we break the 21-day, there are a couple other secondary levels I would be watching, like 60-50. Probably 59.50 is the most important one. That would be the 50-day moving average, also the June swing low. So I think that from a tactical perspective, those are the levels that I would look at for potential support. A pullback within an uptrend probably ends at one of these levels. We break those levels, and then all of a sudden it's no longer a pullback in an uptrend. All of a sudden it's something more significant that we need to be concerned about. With today's bounce, by the way, the RSI is back to the overbought region, just above 70. I threatened to show you this in the introduction, and here it is. This is the relative performance of the small cap ETF, the Russell 2000 ETF, versus large cap, the S&P 500. So if this line is going down, small cap stocks underperforming large cap. If the line is going up, small cap outperforming large cap. You can see over the last 2 years, very few periods where small caps have actually been outperforming. And over the long period of time, you can see by the fact that the 200-day moving average is consistently sloping downwards, shows you that small caps have indeed been underperforming large caps. It's not even been close. Again, with some random little, 3 to 4 week periods where you see a bit of a counter trend bounce, but overall it's been weaker. Now, just in the last couple months, then really from the April low, we had that initial bounce where small caps outperformed, and then they've really been in line. So if you look, when this ratio is kind of going sideways, that means that those two things are moving together. So both small caps and large caps have actually been doing well in May and in June. And just in the month of July now, so far, we're starting to see small caps actually start to outperform large caps. Now, again, year to date, large over small, still very much the story. But this is where we would start to see an inflection point. You start to see this ratio push higher. It may start to suggest that going all in on Magnificent Seven stocks and just holding our breath and nose and just, tracking this uptrend as long as possible, this ratio starts going up. It tells you there's a threat to that particular thesis because other stocks, right, smaller names, not outside of the Magnificent Seven, are starting to do a little bit better. So I think this is a crucial chart to watch here as July unfolds, probably into August, to see if we start to see more outperformance from small caps. Still early days, but something to watch for. One of the other red flags that would tell me to get concerned would be the VIX spiking higher, and we're not seeing that. The VIX actually moved lower today, pushing below 16 for the first time since February. You have to go back to the February market peak for the last time the VIX was this low. So the VIX spiked up into the 50s in early April, and then from there has gently and generally moved lower. Last couple tactical peaks that we saw a pullback in stocks, and the VIX did briefly spike above 20. Those end up being pretty buyable dips here. So for now, VIX is relatively low, which tells us low volatility, high confidence uptrend until further warning. Keep an eye on the VIX, though. A spike on the VIX is a great red flag to look for. Here's a chart I mentioned looking at silver versus gold. I've had a number of different guests that I've interviewed over the years that have talked more about silver. Miss Schneider comes to mind as often bringing up silver, and she always scolded me for just looking at gold. And she would always say, look at both gold and silver because there's something there. She's probably right. And I jot that down on a piece of paper every time I interview her. So with a nod to Miss Schneider, who always reminds me of this, we're looking at both gold, which is in the top panel. This is the continuous contract. So looking at the gold future, but stringing together the current contracts going back over time, which is kind of the convention of how you look at futures over a longer period of time. So here's gold in the top panel. Here's silver in the second panel. Just look at the blue lines here, which are the 21-day exponential moving average. For gold, we can see that the price is slightly below, and the 21-day EMA has been flat for the last month. Look at how silver is generally above its 21-day EMA, which has generally been sloping higher. That's the difference here, right? You can see back here, gold sold off just a little bit as stocks were selling off into their April 7th lows. Silver sold off a lot worse, which is why this ratio jumped higher. But from mid-April now to mid-July, the bet has been silver. So while both gold and silver are okay, I would say from a technical perspective, silver is still very, very good, while gold is a little more of a question mark, right? Gold's starting to break down below, moving average support, while silver continuing to trend higher. So if I have the opportunity, if I have the option of which one of these I would want to own, I'd probably own silver over gold at this point, given the outperformance, given the fact that from a technical perspective, it looks a lot less disrupted than the chart of gold does. Something to keep in mind if, like me, you've got a pretty outsized bet on gold that has probably been built up as gold has done so well. If you're looking for opportunities to, maybe take some profits there, maybe you rotate a bit to silver as an option. I'm going to jot that down to look into that a little bit more for my own portfolio. Bitcoin, boy, what an interesting chart here. We've had a break higher today, and I think this is something to certainly look for. We've had a number of opportunities over the last, last 2 months to break to new all-time highs. We did that in mid-May, breaking above 112,000. We had a failed attempt to do that in early June, and now we're once again trying to push above that 112,000 level, eclipse those May peaks. Now, this is really, I think, derived from the peaks in December of 24 and January of 25, which are just below 110,000. That was kind of the previous ceiling. You can see this is a series of attempts to get above that previous high and maintain that breakout, which it's been unable to do. Maybe this time is different. I like the fact that we're back above moving average support. I like the fact that we're making higher highs and higher lows. I like the fact that the RSI is pushing above 60 today. So keep an eye on Bitcoin, of course, as we attempt yet again to make new all-time highs. I talked about looking at some individual names in the technology sector. It's not all perfect, right? There are some charts that don't look great. This is a great reminder that in good sectors like technology, there are not great charts. And in not great sectors like consumer staples, there are some pretty good charts like, Philip Morris, right, is an example of that. So remember that it's not, every sector, all stocks in the sector do not look the same. Although there can be a lot of similarities and a lot of overlap, there are opportunities in most sectors in most periods of time. Adobe is one of those that I'd probably be playing on the short side if I did. I don't really short stocks very often, if ever. Not part of my general approach. But I would say, if I watch for this, because this isn't a perfect what we call an island reversal, because we kind of overlapped here. But You gapped higher in May, in which certainly looks like an exhaustion gap, a big run higher, a gap which is immediately is sold. Then we had another gap lower, which I would describe as probably an impulse gap or a breakaway gap, which begins a new downtrend phase. From that gap, we've now made lower highs, lower lows. We're below a downward sloping 21-day moving average. We broke up to the 50-day and failed. We're below a downward sloping 200-day. The momentum is overall in the negative range. So obviously, this is a stock that's been underperforming because it's been going down while the markets generally have been going up. But I think most recently, what looked like an encouraging bounce in May, while the major averages, the S&P and the NASDAQ, kind of just continued higher. Look how Adobe is now completely diverging from the rest of technology and from the rest of most U.S. equities. So a chart probably I would be avoiding if I was playing that particular name. While Adobe is struggling, there are charts that are actually looking quite strong. Highlight home builders this week. We're getting into earnings season. I think earnings on home builders are going to be pretty important here. But you saw rates come down today. You see home builders like DHI, Pulte Homes, and others actually breaking out. For DHI and others, the 200-day moving average is starting to be in play again. I think that's an important level to focus on. Charts like this are really impressive, but how many charts have we seen that have these great runs and then get absolutely stalled out at the 200-day and rotate lower? I don't think that's a coincidence. I think that's where a lot of investors kind of naturally, do a litmus test and say, is this really a stock that has staying power? And if not, we fail at the 200-day. This breaking above the 200-day completes a beautiful rotation, certainly in a positive configuration, price-wise, momentum-wise. And it's not just that. This is Builders First Source. We mentioned this on the heat map ticker BLDR. This is in the industrial sector in a group called Building Materials. But, same thing. I think this demonstrates a rotation from a distribution phase to a consolidation phase to an accumulation phase. Now, I've kind of developed my own language to talk about different market phases. If you've heard of like Stan Weinstein's stage analysis, similar kind of methodology, and there are a number of people that have created their own kind of proprietary ways of describing these phases using moving averages and different stuff. I kind of keep things simple, as you probably have guessed. A distribution phase has lower highs, lower lows. We're below downward sloping moving averages. The RSI is generally in the bottom half. In a consolidation phase, we have consistent support and resistance. We're kind of going sideways in a rectangle. The moving averages start to flatten out. The RSI remains generally between 40 and 60. In the accumulation phase, we're above upward sloping moving averages. We're making higher highs and higher lows. The RSI is generally above 50. That's the rotation we've seen from distribution to consolidation to accumulation, from going down to going sideways to going up. I think those charts, the home builders like DHI, like Builders First Source, good charts starting to really improve off of the lows. Final chart today, because earnings season is going to start getting us. We're still sort of in that quiet period before earnings season really kicks off next week. But I would say for now, keep an eye on Delta Airlines. This is a potential bull flag pattern, which is when you have a run higher. And then we have a decline of lower highs and lower lows. That flag pattern becomes a really bullish pattern if and only if we break above the upper boundary. It's been trying to do that over the last couple sessions, has been unable to do so. If you look, the rally off the April low stalled out at the 200-day moving average. I think breaking out of that flag pattern, following above the 200-day, which means you get above like 54 and a quarter or so, all of a sudden Delta becomes a really impressive chart with upside potential. So first things first, we'll see if we break out. Earnings coming out tomorrow. We'll see if that has enough upside momentum to do it. Thought that was an important chart to follow right about now. All right, some great questions, as I can see, on a number of platforms upon which we are streaming. Someone mentioned the Dubai CMT event. I did put that out on social media. That's coming up at the end of September. I hope you will join me and the CMT Association. It's their Global Investment Summit in Dubai. It's going to be at the Museum of the Future, which is a magnificent space. We were there for an event last year, I want to say, year before. And it was fantastic. Absolutely fantastic. I mean, a fascinating city, just a wonderful melting pot of people from all over coming together to talk about charts one of the universal languages, I would argue. So if you're able to get to that region, I hope you're able to join me. You can find more information at cmtassociation.org or on my social media platforms. I sent out a link where you can sign up directly. Sujay, thanks for watching on YouTube. You said, I have a question with the wavy emoji, which is why I picked your question. Thanks so much. As why there's large volume right after the close and the price movement is not much. Not sure what is happening. You can check for reference today's intraday MU stock. All right, look at Micron. All right, here we go, MU. And you had said the intraday volume, price movement right after the volume, right after the close. Let's take a look here. So we'll look like an intraday chart. I don't normally put volume on here, but I'm going to do it. Overlay, good. And then we're going to do extended hours to see if that's something that we're talking about. So I'm not, again, I'm not 100% sure what you're referring, but when I'm looking at the chart of Micron today, volume in the after hours is pretty meaningless. I mean, it's pretty low, and you can just see looking back, there's just not a lot of volume in the after hours session. So this big bar that you see here is the volume in the last like 10, 15 minutes. So generally with any sort of U.S. stocks and most stocks, but I've studied the U.S. equities the most, of course, daily volume has this big U shape. You have a ton of volume in the first half hour. You have a ton of volume in the last half hour. And then you have very little in the middle. And any movement in the middle is probably some sort of news event. Like here you can see Micron selling off with a spike in volume. It's actually pretty unusual. Most of the time, you're going to have this big, gentle U shape. Ton of volume right after the open, after not much in the pre-market. Ton of volume going into the close, not much in the after hours. And that's because the beginning is where you have, it's mostly retail trading. It's a lot of reaction to what happened overnight. If there's any economic data, any news, any earnings, that's all going to be reflected right out of the open. So, the opening price is set. You have a ton of volume as initial bets are made. Then it kind of tapers off over the first hour and a half of trading. Then there's this quiet period during lunch where people are kind of doing other things with their time. There's trading happening, but it's not nearly as heavy. And then things really accelerate toward the end of the day. For one main reason, that's because that's where institutions will trade. And the reason is because as an institutional investor, if you want to accumulate a huge position in Micron, if you do it right in the middle of the day, everyone's going to know some big investor is doing something. So the way you try to minimize that is a lot of different things. You try to break up large orders into smaller little bits. You try to use dark pools and other alternative sources of liquidity, as we would call them. And also you put trades in at the end of the day where the chance of really moving the market significantly is much lower. What you're trying to do, and it's for a good reason, right? What you're trying to do as a big money management firm is buy or sell in a way that gives you the exposure you're looking for or takes the exposure off that you want, which is benefiting your shareholders. But you want to do it in a way that's not going to hurt your shareholders by, if you put in huge buy orders on a ton of volume, you're going to cause prices to spike up. And as a result, you're going to get filled at worse and worse levels. So the game as a buy-side trader is all about trying to minimize impact in the market, but also add or subtract the shares that you need to make the bets you're trying to make for your portfolio. So that's why there's that general U shape. I don't see anything unusual on the chart of Micron. This actually looks pretty normal, like what a normal day for a normal stock traded in the US would probably look like. If there's something different that I'm not seeing that you are seeing, go to my YouTube channel, put a comment below this video, include a link to a chart somewhere on stock charts or elsewhere, and I'm happy to take a look and see if there's something specific going on with the chart that you're looking at. Let's see, one more question. Richard, thanks as always for watching. I appreciate it. You said now that XLF seems to be participating, are we in a bull market? Whew. That's like a day-long webcast kind of discussion right there, or at least an hour-long webcast. I'll give you the quick version. I mean, maybe, right? I'm not as much of a fan of declaring a bull market or a bear market based on which sectors are participating. However, it is generally helpful to know where the leadership is coming from. And so I would say one thing, for me, the general order of operations between understanding the markets, you sort of do the macro level, right? What's working, what's not, what are the big sort of asset classes, currencies, commodities, bonds, stocks, how are they related, kind of making that initial assessment. But then when you go a level down in the equities, it's sectors, styles, themes, right? What types of stocks are working? Is it growth or value? Is it large stocks or small stocks? Is it high beta or low volatility? Is it, any of those kind of comparisons, growth or value? Like just what types of names, what themes are working and what are not? And there are a lot of ways you can make that sort of assessment using scanning tools, just going through charts consistently. You can do that using things like the Scooter ranking, which allows you to rank statistically different ETFs based on sort of an objective measure of price momentum. Do I think it's worth declaring a bull market only because financials are starting to really participate? Not so much. The reality is financials have actually been going up for a while here. And if you look at the XLF making new all-time highs earlier this month, just last week. But to be honest with you, the relative strength has not been particularly good. From late April, the XLF has actually been underperforming. So while the XLF is going up, while a lot of big banks like Citigroup and JP Morgan are coming off of new all-time highs last week, that sector as a whole has still been underperforming the rest of the market. So financials are kind of in that value category that has not been generally the place to be. The other comment I would make is within financial, one of the problems with the XLF in particular is that is just the nature of the companies. We talked about this, I think, on yesterday's show. Remember, just look at the 5 largest names. 3 of these 5 are not big banks, right? I mean, JP Morgan and Bank of America are kind of what we would think of as traditionally what you kind of would expect to be at the top of the financial sector. Those are like the big money center banks. But you've got Visa and MasterCard, which are very different businesses. You've got Berkshire Hathaway, which is a conglomerate which owns a bunch of, Apple and, Coke kind of companies and reinsurance companies. It's not a bank. And so, banks as a separate way of thinking about it might be a better way to think about it. So, I'm a big fan of looking at these, the spider ETFs, KBE, which would be the bank ETF, KRE, which is the regional bank ETF, KIE, which is the insurance ETF. If you looked very quickly as I was doing that, insurance, absolute disaster off of the April market low. Regional banks, kind of but in the last couple of weeks, you're starting to see the relative performance improve as that chart is broken out. And the same with the KBE, which is sort of, larger banks, relative strength starting to improve, price starting to break out. So insurance has now become a negative outlier. Other areas of the financial sector looking pretty good. So I think it's less about financials looking good. That's great for the markets. I think it's more about there are certain charts within the financial sector that look better than others. So keep an eye there. And that's where things like the market carpet heat map kind of stuff or scans can help you focus on where you really are seeing stocks demonstrating strength. That'll do it for today, folks. Awesome questions, a number we didn't get to, and I'll add those to the mailbag. I look forward to answering them on Friday's episode. Keep the great questions coming. And thanks so much for watching. Tell your friends. Always happy to have one more person watch Chart This with Dave Keller. For now, we'll call it a night. Thanks so much for watching. And remember, it's always a good time to own good charts. Have a good night, folks.